The committee will come to order. This morning we'll begin a review of the failure and government rescue of the world's most celebrated hedge fund, long-term capital. I say that we'll begin the review because a failure of this magnitude and the Fed's decision to intervene on behalf of a private company raised profound public policy questions, some of which may not become evident for some time, to which this and other committees will no doubt return later in this or the next Congress. Hedge funds were so named because their managers tried to reduce with offsetting transactions the risks they were taking with investor funds. Today, the name has an ironic ring. As hedge funds have grown in the last few years, so has the venturesome nature of their investments in pursuit of ever higher returns. The industry numbers between 3,000 to 5,500 funds and somewhere between 200 and 300 billion in investment capital. About a third of the funds are highly leveraged, in long-term's case about 27 to 1. That means these funds are supporting booked assets in the order of $2 trillion. Large financial institutions make this leveraging possible, often with federally insured funds. If taxpayers share in the risk, they, or at least their protectors, bank regulators, and in some cases the CFTC and SEC, ought to understand what risks are involved. The profit motive is the most powerful disciplinarian of markets, but the United States government is obligated to be on top of the issues. Risk-free regulation is not possible or necessarily appropriate. The economy could be as ill-served by financial institutions refusing to take risks as it is by those taking too much. Hence, the question of whether and how to establish appropriate regulatory oversight are judgmentally elusive. Speaking as a member of this committee who has been pushing for more disclosure by financial institutions and closer cooperation among regulators, I'm well aware that the Congress is not the optimal institution for setting precise supervisory standards. An attention to margin requirements, for instance, may be an appropriate tool, as Muriel Siebert will suggest to the committee this afternoon, particularly for that part of the hedge fund industry that is leveraged with borrowed capital from already leveraged institutions, i.e. banks. However, it seems to me wiser to give discretion to establish restraints of this kind to an institution such as the Fed, rather than attempt to design an arbitrary approach within Congress, a body that lacks the necessary sophistication on matters of this nature. But Congress cannot duck its oversight responsibility of those charged with supervision of these markets. The troubles of long-term capital confronted the Fed with a catch-22. If it failed to act in the face of what it presumably deemed to be systemic risk, it would have been left open to charges that it abdicated leadership on a matter that might have affected the stability of markets around the world, and thus the pocketbooks of millions of ordinary citizens. By acting as it did, however, it preserved an institution that in a free market economy would normally have been allowed to fail. It would appear that the Fed's intrusion into our market economy can be justified only if it can be credibly shown there was a clear and present danger to the financial system and long-term capital's failure, and that there were no stabilizing alternatives, i.e. other credible bids on the table. Although no public money was involved, this is the first time the too big to fail doctrine has ever been applied beyond insured depository institution. This intervention is also the first one in my memory that involved a commitment of funds by those summoned to the elegant quarters of the New York Fed and the formidable presence of its president, Mr. McDonough. Other Fed interventions generally turned to more technical questions. In this regard, it's only reasonable for Congress to expect an explanation from President McDonough, who called and hosted that extraordinary gathering of Wall Street power brokers. From a social perspective, it's not clear that long-term capital or any other hedge fund serves a sufficient social purpose to warrant government-directed protection. In one view, hedge funds provide liquidity and stability in financial markets, making it possible for large companies like General Motors and IBM to issue billions of dollars in bonds without causing interest rate distortions so as to facilitate the building of factories and creation of jobs. In another view, hedge funds have a narrow raison d'etre. They're seen by some to be run-amok casino-like enterprises driven by greed that with their sheer size can control markets in certain circumstances, even jeopardize the viability of sovereign states. From a regulatory perspective, the long-term capital fiasco is instructive. Federally insured institutions are subject to well-understood regulation, which among other things places a premium on prudence and disclosure. In this case, however, some of the country's largest and most sophisticated banking institutions provided loans and, according to a long-term capital officer, fought for the privilege for doing so, to an institution that shielded its operations in secrecy, denying lenders and the regulators any data about its positions or its liabilities to other lenders. The rationale was that sharing information was competitively disadvantageous to the fund. Implicitly, however, this practice made lenders to the fund responsible for a kind of blind-eyed banking practice that no community bank I know would countenance, and complicit in speculative actions that might in some cases prove destabilizing for the very financial system upon which banks and the public rely. Long-term capital was the envy of its peers, the very paragon of modern financial engineering. With 2 Nobel Prize winners among its partners and Wall Street's most celebrated trader as its CEO. The fact that it failed does not mean that the science of risk management is wrong-headed, just that it is still a fledgling art in a world where the past holds lessons but provides no reliable precedents. There are points where politics and economics intersect, and when political institutions implode, as they did in Russia, economic consequences follow. The best and the brightest, from George Soros to John Merriweather, lost billions betting on a more stable ruble and relatively weaker dollar. This underestimation of America, which became reflected in a growing divergence rather than convergence of various bond valuations in contradiction of mathematical models based on historical patterns during times of relative market tranquility, should give pause to bank managers and regulators alike. At issue is not just a judgment of the moment, but the problem of applying mathematical models in adverse times, especially when the vicissitudes of politics and human nature conspire with market forces. In retrospect, it's difficult for a neutral party not to be struck by the fact that the best and the brightest in the hedge fund industry could commit such strategic errors, that the best and the brightest in the investment banking industry would give a blank check to others in an industry where they are also considered to be experts, and that the U.S. regulatory system could be so uncoordinated and so easily caught off guard. The Fed and the OCC, principally the Fed in this case, have responsibility for regulation of the banks which extended such large credit lines to long term. Questions exist as to how on top of loan extensions were these regulators. The principal agency with statutory authority over the fund is the Commodity Futures Trading Commission, with which long-term was registered as a commodity pool operator and to which it was required to make periodic financial disclosures. According to CFTC officials, the Commission has the power to examine its books at will. It apparently didn't do so even after long-term capital reported at the end of '97 that its assets included nearly $3 billion in swaps, forwards, futures, options, and warrants, and its liability $6.4 billion in similar instruments, or that it leveraged $4.7 billion in partners' capital into investments of $129 billion. I agree with Chairman Bourne that long-term capital's troubles are a wake-up call about the risk OTC derivatives may pose to the financial system. But it's disappointing that a prepared statement does not provide the committee with an autopsy of the fund of what went wrong and why. Instead, it confines itself to an argument for a policy that, in the view of the other financial regulatory agencies, increases the very risks, such as the problem of maintaining legal certainty on contracts when problems of this nature arise, that she decries. The 6 financial companies that now supervise long-term capital, as well as this fund executives, were invited to appear before the committee. All declined. Given the public policy issues at stake, this circumstance is noted with concern. The long-term capital saga is fraught with ironies related to moral authority as well as moral hazard. The Fed's intervention comes at a time when our government has been preaching to foreign governments, especially Asian ones, that the way to modernize is to let weak institutions fail and rely on market mechanisms rather than insider bailouts. We also have encouraged these countries to establish bankruptcy arrangements to cushion the shock of failures and, where possible, fairly distribute the assets of bankrupt institutions. Now, as the country with the most sophisticated markets, bankruptcy laws, and legal precedents, we appear to have abandoned the model we urge others to follow. Or worse yet, the federal government may have played a role in precipitating a bailout offer more advantageous to the failed management than the free market offered. Let me just conclude by saying that the terms of the rescue package engendered by the Fed also raises troubling questions of financial concentration and antitrust. As a group working together, the new owners can have a greater impact in markets than in competition with one another. In this regard, it should be understood that the Fed's unprecedented extension of the too-big-to-fail doctrine of a hedge fund does not insulate the fund and its new owners from the constraints of the Sherman and Clayton Acts. The bailout may involve a tendency towards concentration that the Justice Department has an obligation to review. Mr. LaFalce.
Thank you very much, Mr. Chairman. First of all, I appreciate your expeditiously holding this very important hearing, for interrelated set of circumstances compels immediate congressional inquiry. I also want to say that I associate myself with all of the remarks that you just made. I regret, however, that bankers and banks who loaned to long-term capital management are not appearing today, despite the fact that you invited them. I understand their reticence, since business ramifications are proprietary, but I regret it just the same. Global markets are in turmoil, and domestic economic deterioration is appearing, as Chairman Greenspan has said, around the edges. On Tuesday, the Federal Reserve adjusted the funds rate downward, modestly, in order to counter the trend and increased at least national and probably global liquidity. I applaud that action. However, monetary policy can only go so far in addressing economic concerns. More broadly, we need our financial regulators and relevant domestic and international agencies to function effectively as rapid response teams to address today's economic perils, whether domestic or global. This Congress is not helping in that regard. Speaker Gingrich and Majority Leader Armey, for example, are still causing an IMF impasse, which I continue to call shameful, irresponsible, and flirting with disaster. Such problems in this House, nevertheless, make it even more imperative that other features of our economic defense system be in readiness. We need to know now if the necessary machinery is prepared to function when needed. I was here, as the chairman was, in October 1987. As experience shows, we can very suddenly confront economic turmoil with dangerous implications. Chairman Greenspan, you were in place a dozen years ago to the month, as I recall, when our regulatory team had a very difficult time coordinating a strategy. As I recall, the then chairman of the SEC was publicly hinting at a closure of the New York exchanges in interviews, while the Treasury was thinking no such thing. That might sound trivial today, but it was certainly not considered trivial at the time. The events surrounding LTCM are a useful test case. I hope this hearing serves at least three purposes. First, this should help us evaluate the ability of government regulators and agencies to respond quickly and adequately to situations that could threaten the financial sector and our economy. In particular, with this panel, what is the appropriate role of the Federal Reserve under existing law and regulation in overseeing lending of this nature by creditor institutions it otherwise regulates? I'd like to know how much insured depository institutions had already loaned to LTCM even before this so-called bailout action. What role did the Federal Reserve then play, especially the New York Fed, Mr. McDonough, in facilitating this bailout? And what role should it properly play? Secondly, I think we must look into very legitimate questions regarding who benefited and who suffered, and who will ultimately benefit or suffer from the hedge funds' failure and takeover. So many of these hedge funds have billed themselves as exactly that, hedge funds. They're engaged in arbitrage and risk management, not speculative investment funds. Are they open to legal liability because of the mismatch between their advertising or marketing and their performance? Were they insured? What is the role of the insurance companies, both in any liability that may exist, and what is the role of the insurance industry in monitoring whether the practices of the funds are in conformity with the marketing of the funds? And have we, through our catalytic action, made insured depository institutions substitutes for the insurance companies in this instance? Just questions which I hope you will address. And third, even though LTCM was led by men of great intelligence, including, I believe, 2 Nobel Prize winners specializing in risk management, which may have been one of the attractive features of the fund, markets can surprise the very best of minds, and complex investment strategies are always full of uncertainty. There's some other similarities to 87. LTCM supposedly threatened a market meltdown by a hedge fund. Such hedge partnerships are not new in concept, but they are certainly new in size and scope and importance. In 87, another novelty, program trading, was one of the main culprits. It too was not totally new in concept, but was new in size, share of volume, and importance. In short, novel business arrangements, often involving high speed and substantial complexity, can create unexpected results since no one fully understands their implications until after the fact. Consequently, group effort becomes even more important. Program trading resulted in the circuit breaker regime for stocks and exchange-traded derivatives. Despite being greatly and justifiably liberalized, we still need and use them almost daily. Emerging hedge fund power and influence also might require new or improved regulatory systems. These might need to address the hedge funds themselves or the exchange or over-the-counter derivatives that play such a big part in the lives of such entities. I also wonder if this would cause the Federal Reserve to reconsider its position with respect to FASB's proposed regulations. Beginning to judge the need or lack of need for such regulation should be a main theme of our hearings. And the answer in part will rest on how well the members of our present rapid response team have handled LTCM using the authority and interrelationships they now have. I make no judgments about the failings or successes of one party or another based on press reports, but I do have some concerns. First, LTCM has become a flashpoint in the ongoing debate, often regrettably bitter or apparently bitter, amongst the agencies on the administration's financial working group about jurisdiction concerning OTC derivatives. Due to the controversy surrounding the until March 99 standstill amendment on further CFT action in this area, I'm concerned about the level of coordination and cooperation amongst our regulatory team. Some are saying the CFTC should have been aware of the situation since it was the only federal agency with which LTCM had to register. But the CFTC could accurately respond that registration only provides it with imperfect data. It can only compel reporting on exchange-traded commodities and could have no idea what LTCM's profile might have been concerning OTC derivatives or long positions in regular stocks and bonds. Secondly, Chairman Levitt noted in testimony this week before the Commerce Committee that the SEC was monitoring the brokerage houses under its jurisdiction and pressing them to take care with credit and other dealings with LTCM. However, he too cannot get an overall picture since bank credit monitoring is housed elsewhere. In any case, the Investment Company Act and the Investment Advisors Act remove the SEC from registration and supervisory responsibilities for hedge funds. In the meantime, through high leveraging, LTCM might have gone to better than $1 trillion in notional assets with better than $100 billion in at-risk assets. Better than $100 billion when it's my understanding that their capital may have been approximately $4 billion, which raises another fundamentally important question. What legal requirements exist or ought to exist with respect not only to capital, but with respect to margin requirements? If you have $4 billion and can go in excess of $100 billion, it sounds to me that you are harking back to the era of the 1920s when you had minimal margin requirements. Is there any existing regulatory authority to address what I think is grossly inadequate margin requirements, or should Congress act at least on this issue alone, quickly and expeditiously? Third, when the Federal Reserve did step in, they were at least faced with the fact that some of its most prominent former officials are partners in LTCM or lenders in brokerage firms. Further, high-ranking officers of lenders to LTCM are also investors in LTCM. And I'm just wondering if that causes any concerns to you or should cause concern to us. I have a great many additional points, but since I've taken an appreciable amount of time, I would ask unanimous consent to include the rest of my remarks in the body of the record, Mr. Chairman.
Without objections ordered, the chair would also like unanimous consent to put all other statements in the record, to revise and extend his own statement, and to put a statement from the Secretary of the Deputy Secretary of the Treasury in the record without objection. Does anyone else wish to be heard? Yes, Ms. Rucker.
Yes, thank you, Mr. Chairman. I certainly want to thank you for your a comprehensive outline of the issue, and of course for what Mr. LaFosse has added to it. This subject is esoteric to many people. It's not like talking about the prime rate or interest rates, but we have a good hearing set for us today, and I want to thank you for calling the hearing and giving, it's very relevant today given the roiling financial markets, both domestic and global. And certainly we want to understand the relationship, if any, and what action we may or may not take. But we have to understand this most esoteric subject. The hedge fund industry, as we know, has been a growing one in recent years. And purportedly, hedge fund exemption from Investment Company Act registration requirements has been stated that the investors in these funds are not regular retail investors like you and I. Rather, these hedge fund investors are supposedly sophisticated investors who understand the risks and have the financial wherewithal to lose their entire investment. Well, that doesn't seem to be the case here. The spectacular failure of LTCM LP is quite remarkable. And even though we had they bragged about two poet laureates, former Fed vice chairman and bond trading legend with a questionable reputation, that's my own editorial comment, Mr. John Merriweather, it had been described as the Rolls-Royce of hedge funds. Well, apparently it wasn't that, and I won't go into a repeat of the meltdown that we're all familiar with since August of this year. But there are several questions that I think we need to look at. Significant additional regulation, limits on leverage, and specific bank reporting to the regulators of the loans to hedge funds. Most of them have already been mentioned by our chairman, Mr. Leach, and referenced by Mr. LaFosse. These are important questions, but I want to stress a couple that I have on my own mind, and that is, what are the implications for the financial safety net in specific terms? The rescue plan, and it was a private rescue with no government funds being issued, was funded by the biggest security firms, whether they're Merrill Lynch, Goldman Sachs, I won't name all of them, but also banks, Bankers Trust, J.P. Morgan, Chase Manhattan, UBS, and others. And the logical question does come up, are there implications of public costs? Did the fact that the Federal Reserve hosted and participated in these meetings provide an implicit government guarantee? I don't know. I ask that as an honest question. What are the too big to fail and the accompanying moral hazard questions posed by the financial rescue? And I'm sure that the two gentlemen on our panel, first panel, are going to address themselves to that. Another question I have, and this is an important one, given the Asian currencies markets, and what some commentators have suggested, that it was extreme currency trading pressure from hedge funds and others that caused the Thai baht, did I pronounce that correctly, and the Indonesian and the South Korean currencies to collapse. Is there any truth to these assertions? Are there global implications here of an extraordinary nature that we should better understand, because it is an interrelated global economy? And Another question is, how are the hedge funds, to be monitored and regulated in the international arena? The administration has requested, as I understand, an international financial summit for the G22 nations to look at revamping the world's financial systems. And most recently, Tony Blair of Great Britain, Prime Minister, has stressed that. The meeting is to begin here in Washington in the near future. I will note that if there is anything, if anything, the administration, I regret to say, is not here today, but that they have not been very articulate on how they view the necessity for action, either on their part or congressional action, on these questions. I might also add that there is a concern among many that if we implement a new regulatory scheme here at home or place certain restrictions, this may only force the hedge funds offshore into unregulated, unsupervised countries, and that would not be a good result, and it might be a terrible unintended consequence. Mr. Chairman, there are a lot of questions here today. I'm going to limit my remarks so we can get on to the questioning, but I would draw to the attention and ask unanimous consent to have inserted into the record, following my opening statement, an article from today's New York Times, the editorial observer Floyd Norris, entitled "Risking Everything on One Big Gambler." It states very essential public policy questions for us to answer, and I would like to have that included in the record following my opening statement.
Without objection, so ordered.
I thank the chairman.
What I would like to at this point is turn an opening statement from the ranking member of the subcommittee, and then I would like to ask that we have limit opening statements to greater brevity. But I
will try and agree, Mr. Chairman. I agree with you.
But the ranking member is entitled to a full statement.
Well, thanks. I want to commend you for the hearing. I think that you know, it's ironic we're on the verge of passing a major financial restructuring bill, H.R. 10, and this LTCM incident has occurred. Understanding the concerns of the Fed and that this would lead to a domino effect in terms of long-term capital bankruptcy and other adverse impacts on our economy, I think this points out it isn't just operating subsidies, it isn't holding companies. This particular moral hazard issue is something embedded in our economy. And I don't discount the role of the Fed. While I understand the principles involved, I think we have to know and look to who was, in fact, bringing these parties to the table in terms of our governor, chairman of the governors, and the Treasury. It's interesting, of course, to note this role for the regulators during the evolution of this problem. One wonders where they were. The question persists as should the Fed board have been there orchestrating a bailout or not. I'm sure in some minds, what is appropriate? What is the appropriate role for regulators? You know, this does lend, in my mind's eye, some credibility to the CFTC's earlier concept release, or at least a concept of some regulator looking at the entities. There seems to be a lot of concerns, but if we can discount the turf conflict, I think we come up. But I find it ironic that nobody has responsible, but everyone seems to agree that the CFTC shouldn't have it either. In my judgment, of course, an old science axiom is nature abhors a vacuum. And it appears that when a crisis looms, splitting infinitives is forgotten. And I think that's good. But this issue is, if we are involved in the landing, shouldn't we have a voice in the takeoff and when on board a compass as to where we are trying to go? And I think we can rely upon issues like deposit insurance, but it seems to me that that is trying to drive through by looking through the rearview mirror as to what's going on. So I don't think that while we have some controls there, I don't think it's acceptable. Now, I remember when we were dealing with the systemic risk question in terms of too big to fail, and one of the amendments that we added to the bill, for instance, we had the opportunity for the Federal Reserve Board to deal obviously with the issues with banks, and we also had in the law, although I don't know that it's been used, a provision dealing with large industrial entities. We added a provision that provided for the opportunity to deal with other financial industry entities, namely securitization and other purposes. So we did actually make an affirmative action in law in the last decade on that particular provision of law. I remember because I was working on the amendment. But I think that the case here gets back to, so there is some authority, there is some responsibility there. How that has been exercised, of course, is what we're talking about today. I think a greater case can be made for transparency, but this runs us right into the sort of debate that occurred with regards to the FASB rule and whether or not we're getting into proprietary information and whether or not we, in fact, do drive things offshore. Although I think that argument is somewhat limited in terms of looking at the volatility around the world and recognizing the significant advantages, of course, being within our economy and having the benefits from it. Now, on this, of course, I think the concern we have here is that, we hear a lot of speeches about free enterprise in the marketplace, but a lot of folks don't like to practice it. And I think the problem we have as representing our constituents is that there seems to be two roles here, one a double standard, one for Main Street and another one for Wall Street. And while I'm very interested in terms of a mixed economy, I don't believe in economic Darwinism or going to economic ground zero in this country or around the globe. The fact of the matter is, I think we have to be convinced that there are some predictable standards, some predictable behavior and role that is out there that, in fact, there are expectations that are going to go with regards to this. If there's public policy, for instance, we hear a lot of complaints in this role about, for instance, providing a low-cost checking account or CRA. There are bitter opposition to these types of things, but yet we get involved in these types of use of public power to select winners and losers. Without a vote by us or anything else, and the question is, when we begin to talk about franchise and utilization of this to serve other purposes, I'd like to see a more appropriate response to this. Today, of course, we can affirmatively identify the role, responsibility, and results, and hopefully set a clear policy path as to guide similar actions in the future. I just think that this idea of having this occur without more transparency and without some logical sequence of events and standards is of great concern to me. So I'll be looking for those answers in my questions in the testimony today. Thank you, Mr. Chairman. It's a good idea to have this hearing. Thank you.
Thank you. Let me explain. There are two committees, subcommittees of jurisdiction, and one is headed by Mr. Baker, and I'd like to recognize him at this point.
Thank you, Mr. Chairman. I appreciate your courtesy. I shall try to be briefer than the normal allocated time. I thank you very much for the calling of this hearing in such a timely manner, and point first to the series of questions that I prepared, which I know you will conclude as part of the record and not recite all of them, but there are some principal issues that I think need and deserve critical attention. When and how, for example, did the concept of market self-regulation fail us in this instance, which has been regulators' views till this point in time? When margin calls eroded $4 billion of capital down to $400 million of capital in less than 60 days, when a $3.5 billion workout plan was confected, and we still find ourselves with about $400 million of cats and dogs that have to be unwound, how is it that that convoluted a process could be engaged in without regulators recognizing the credit extensions by the insured institutions? And finally, did any of the investors in the workout have significant financial interests or management responsibility in the firms that were ultimately recapitalized, thereby saving their own financial fortunes as a result of the intervention? I think these are extraordinarily important questions, and I have others which I hope to be able to have time to ask at a later moment, but this cannot be understated as being one of the more serious financial difficulties of this century, and I hope that we are going to be comforted that the regulators do now in fact have plans in place that would help to avert such unfortunate circumstances in our future. Thank you, Mr. Chairman.
Well, thank you very much. And I must say, I don't think any member of Congress has devoted more time to issues of this nature in a more thoughtful way than you have, Richard. Thank you. Mr. Kondraski.
Thank you, Mr. Chairman. Mr. Chairman, I guess I'm interested to know from the testimony today is what was the breakout of exposure here of the investors and the institutions that are particularly federally insured, and in what amounts? And then the question is, what did they know and when did they know it? It seems to me that there's a failing here in the inspection system to protect the federal taxpayer in terms of 60 days and a bleed of only $4 billion in equity and over $100 billion of exposure, mostly coming, or a good portion coming from insured funds. We don't know the exact proportions. At what point should the banks and should the regulators have known this? And what were the obligations between the parties? And then I'm much interested in what the relationship of the investors and the potential conflicts of interest that are here that would clearly call for us to look at a regulatory scheme that would prevent insider dealing or investor dealing in the future with potential conflicts of interest. Thank you for calling the hearing. I look forward to the testimony, Mr. Chairman.
Does anyone else wish? Yes, please. Mr. Bacchus.
Thank you, Mr. Chairman. First of all, we're talking about which subcommittees have jurisdiction, and I'm not sure what we've decided, but if we've decided that the Oversight Subcommittee does not have any jurisdiction, I'm glad that we've decided that. And I will second your conclusion that we did not have jurisdiction over this matter. Let me say this. Our subcommittee has been focusing on rescue plans and what we call bailouts, and that's bailouts of foreign countries. And I think we've now come full circle in that we have been talking for so long about moral hazard, the doctrine of moral hazard. We've also been talking about another doctrine, and that's the doctrine of too big to fail. And it seems to me as if with long-term capital, we've had a collision of these two doctrines, too big to fail and moral hazard. And apparently the victim in all this and the doctrine that's been totally disregarded is moral hazard. What should happen to a large hedge fund that's grossly over-leveraged when it fails? Or what should happen to a country or a large corporation when it fails? Should we have a federally sponsored or engineered rescue or bailout? You know, we address that with Mexico. Mexico is too big to fail. It would have implications for our markets. But at the same time, some of us, Mr. Sanders and I, argued, why do we bail out these investors? Moral hazard. We are creating a situation here that could come back to roost. And I would say that that is happening today. Russia, too big to fail. We went in and we rescued them. And when we rescued Mexico, when we rescued Indonesia, when we rescued Russia, we helped rescue these same hedge funds and the investors in those hedge funds and allowed them to continue to over-leverage and over-invest or to make risky investments. So I would simply say this. Today, where is the doctrine of moral hazard as far as the Federal Reserve is concerned? What does the doctrine of too big to fail mean? And the last thing I will say is this: we also do need to we do need to look. I would say the focus does not need to be on hedge funds, because I don't think we're going to ever be able to regulate hedge funds. They're going to go overseas. They're going to, in fact, Mr. Ely on CNBC last night said trying to regulate a hedge fund is like trying to nail a jellyfish to a wall. And I would agree with that. But we do have regulatory oversight and responsibility for regulating lending practices and our banking institutions. And so part of this hearing ought to be to ask the questions: did our institutions loan too much? Were these prudent and reasonable loans? Did the federal banking regulators fail to monitor the situation? I appreciate y'all's presence here, and I hope that at some point we're going to go back to what we require of welfare mothers when we've said you've got to go back to work, What we've said to small businesses when they fail, you've got to take the loss. What we've said to farmers, what we've said to our people here in America, and that's that it's not the job of the federal government to rescue you, and that ought to also apply to rich Greenwich, Connecticut investors who've multimillionaires. So we ought to use the same standard that we've used on welfare mothers on these large hedge funds. Thank you.
Well, thank you very much. Does anyone, Mr. Sanders?
Thank you, Mr. Chairman, for holding this important hearing. Let me begin by reading from a quote from the New York Times that appeared a week ago Thursday. And I quote, "A week before the long-term bailout was negotiated at the headquarters of the Federal Reserve Bank of New York, Alan Greenspan, the Fed chairman, testified to Congress that bankers knew exactly what they were doing in the policing of hedge funds and their attendant risks. On September 16th, he assured Representative Richard Baker, Republican of Louisiana, that risk in hedge fund lending was well under control." I guess that was 1 week before the bailout. Mr. Chairman, Alan Greenspan is here with us today, along with Mr. McDonough, and we expect that they're going to explain to the members of this committee why the global economy remains unstable, why the Federal Reserve has organized a $3.5 billion bailout for billionaires, why Americans should be worried about the gambling practices of the Wall Street elite. In my state, you know, people buy a dollar lotto, but they don't usually invest hundreds of millions of dollars in these types of gambling practices. Now, let me begin by quoting from a recent op-ed piece in the Washington Post by James Glassman, picking up on a point that Mr. Backus just made. Quote, "In America today, there's a double standard." I should point out Mr. Glassman is a conservative. "A rule that applies to welfare mothers doesn't apply to politically connected corporations, rich speculators, and irresponsible nations. Over and over again, when powerful people and institutions get in trouble, the government bails them out." End of quote. Not when family farmers get in trouble, not when small business people get in trouble, not when poor people get in trouble, but I guess to get government assistance or the help of the feds, you got to be a multi-billionaire gambler. Now, let's take a moment to understand what in fact has been happening. What we have here, so far as I can understand, is a man by the name of John Meriwether, who went to some of the largest banks in America and asked for $100 billion in loans to gamble on whether income rates would increase or decrease. Like any gambler you might find in Las Vegas, Mr. Meriwether, after several years of success, I should say, apparently went too far. He gambled himself into a situation where one company lost, his own company lost some $90 billion, and according to the New York Times, this hedge fund's speculation topped $1.2 trillion. Now, what is $1.2 trillion? It's an astronomical sum of money. It is close to what the budget of the United States government is for 1 year. That's what we're talking about. This is one man whose actions and poor judgment could cause economic catastrophe throughout the entire world, one person. Now, we hear a lot about crony capitalism in Russia, crony capitalism in South Korea and in Indonesia. Chairman Greenspan, I hope in your testimony today that you will talk about crony capitalism in America, about one man's investment threatening the entire economic stability of the globe. What we have here are banks that are willing to lend billions of dollars to one man so that he could gamble on whether interest rates go up by 0.5% or whether they go down by 0.5%. But meanwhile, these are the very same banks that refuse to loan money for economic development and job creation in communities all over America. Evidently, there is not enough money from these banks to invest in job-creating small business, in job-creating family farming, in job-creating manufacturing, but there is unlimited amounts of money to be lent to gamblers in their non-productive efforts to guess if interest rates will rise or fall. Mr. Chairman, there are changes taking place all over this planet. You will note that recently in Germany there was an election in which conservatives lost. A year ago there was an election in France where conservatives lost. 2 years ago there was an election in Great Britain where conservatives lost. All over Europe and throughout the world, there is growing doubts about the sensibility of the Thatcher, Reagan, if I might add, Greenspan approach to economic development. An approach which says that it is okay for a couple of hundred billionaires throughout the world to own more wealth than the bottom 45% of the world's population. An approach which says that it's okay in the United States for one man to own more wealth than the bottom 100 million Americans. So I think the good news is that Europe is beginning to wake up that this laissez-faire type of approach, where let's knock down all barriers, let's oppose minimum wages, let's oppose national health care programs, let's oppose any action that helps working people and poor people. That's bad. But let's give the billionaires the opportunity to make more and more and more money so that we have a situation where one man can have an influence over $1.25 trillion, and truth of the matter is nobody has a clue what's going on, and Mr. Greenspan, a week before the collapse, says that the banks know what they're doing. So I would suggest that this issue today deals not only with this hedge fund, but our entire approach to the global economy, where so few people own so much wealth and have so much power, where the IMF is running dozens and dozens of countries throughout the world. And I think we had better learn from Europe's recent elections and start rethinking this entire approach to the global economy. Thank you very much, Mr. Chairman.
Thank you. Mr. Castle.
Well, Mr. Chairman, I will be brief, and I don't go as far as Mr. Sanders, nor do I sit here and say that I truly understand hedge funds, but this is remindful to me of the savings and loan debacle, only a lot more leveraged even than the savings and loan situations were. And I think it's sort of what I view as the corollary of too big to fail, and that's too small to succeed. I look at my own little mutual funds and sort of pitiful real estate investments and how they've done this year, and nobody's come in to help me particularly, but I think I reflect what a lot of other people are thinking out there. You know, why should the New York Fed step in and help in this circumstance with persuasion, perhaps, not direct help, when their own investments are not doing as well? That's a legitimate question for the American public, and I think something that should be answered today. But let me just say what I'd like to get out of this hearing today. I really would like to have a better understanding of the problem. I mean, the scope of the problem. And I view it as a problem, by the way. I'm not just using that expression lightly. I think the anonymity here, the banks not knowing about the credit extensions by other banking institutions, to me is very bothersome. The mere size of this is extraordinarily bothersome. So I'd like to know more about the problem. I'd like to know what the potential solutions are to that, and I don't know what that should be. I'm not suggesting we should legislate or regulate or whatever it may be, but somehow or another, it just doesn't seem quite right to anything this large with the potential to collapse and to create a systemic problem of the magnitude that this should exist without us stepping in and making it better understood and being able to prevent that kind of thing from happening. And what I hope we avoid today is obfuscation and deflection as if there is no problem whatsoever. I just don't view it that way. So I say that not just to you two gentlemen, but to everybody who's going to testify. Hopefully when this day is over, we're on our way to a solution. With that, I yield back the balance of my time.
Well, thank you very much. Does anyone else wish to speak? If not, we'll turn to our, excuse me, Dr. Paul.
Thank you, Mr. Chairman. Mr. Chairman, I appreciate very much you holding these hearings. The world financial markets have been in chaos now for nearly a year and a half. The problems surrounding long-term capital management is only one more item to add to the list. The entire process represents the unwinding of speculative investments encouraged by years of easy credit. The mess in the world financial markets was a predictable event. Artificially low interest rates and easy credit caused malinvestment, overcapacity, excessive borrowing, and uncontrolled speculation. We've had for 27 years a world saturated with fiat currencies, and not one has a definable unit of account. There have been no restraints on the monetary authorities to expand their own money supplies, fix short-term interest rates, or deliberately debase their currencies. Although short-term benefits were enjoyed, it is clear now they were not worth the resulting chaos. We need not look for the cause which puts the dollar, our economy, and our financial markets at risk. The previous boom, supported by the illusion of wealth coming from money creation, is the cause of current world events, and it guarantees further unwinding of the speculative orgy of the past decades. This cannot be prevented. All that we can hope to do is not prolong the agony as our monetary and fiscal policies did in the U.S. in the 1930s and as they are doing currently in Japan and elsewhere in the world. More Federal Reserve fixing of interest rates and credit expansion can hardly solve our problems when this has been precisely the cause of the mess in which we currently find ourselves. Price fixing of interest rates contradicts the basic tenets of capitalism. Let it no more be said that today's mess with financial markets is a result of capitalism's shortcomings. Nothing is further from the truth. Allowing the market to operate, even under today's dangerous conditions, is still the best option for dealing with hedge funds, gambling mistakes, both current and future. A Federal Reserve orchestrated an arm-twisting bailout of LTCM associated with less than a coincidentally announced credit expansion only puts long-term pressure on the dollar. All Americans suffer when the dollar is debased. Congress's responsibility is to the dollar and not foreign currencies, not foreign economies, and not international hedge funds which get in over their heads. No amount of regulation could have prevented or in the future prevent the inevitable mistakes that are made in an economy that is misled by rigged interest rates or a money supply dictated by central planners in a fiat money system. Hedge fund operations, because they are international, are impossible to regulate. And for the current ongoing crisis, it's too late anyway. Credit conditions that allow a company with less than $1 billion in capital to buy $100 billion worth of stock with borrowed money and manage a $1.2 trillion worth of derivatives is about as classic an example as one could ever find of speculative excess brought on by easy credit. As long as capital is thought to come from a computer at the Federal Reserve and not from savings, the financial problems the world faces today will persist. Thank you, Mr. Chairman.
Thank you, Dr. Paul. In turning to the panel, normally we begin with the chairman, but I understand you might want to reverse the order today. Is that correct? Then we'll begin with President McDonough. And let me say we welcome you, Mr. McDonough, as the panel understands you are the president of the Federal Reserve Bank of New York. Mr. McDonough.
Good morning, Mr. Chairman and members of the committee. I'm pleased to appear before you today to describe the Federal Reserve Bank of New York's role in the events leading up to the recent private sector recapitalization of long-term capital management and its fund long-term capital portfolio. I will cover 4 points and seek to answer many of the questions that have been asked. First, I will provide some background on long-term capital's financial problems. Second, I will explain our judgment that an abrupt and disorderly closeout of long-term capital's positions would have posed unacceptable risks to the American economy. Third, I will explain the limited role we played in facilitating the private sector resolution to this private sector problem. And fourth, I will identify some of the issues that should concern us as we begin to understand the lessons of this experience. Long-term capital is an investment partnership that was started in 1994. It has many of the characteristics of a hedge fund in that it borrows money to leverage its capital and is only available to wealthy investors. The strategy of long-term capital was to use complex mathematical formulas to identify temporary price discrepancies between different interest rates. For example, the firm might notice that the yield on corporate bonds relative to Treasury yields was higher than the range observed in recent years. If long-term capital believed the former relationship would reassert itself, it would buy corporate bonds and sell short Treasury bonds. If the spread narrowed as expected, the firm would profit. If, however, the spread continued to widen, the firm would incur losses. This basic strategy and many complex variations was followed across many interest rate products in the U.S. and many overseas markets as well. The firm was active both in traditional securities markets and perhaps more importantly in derivative product markets such as futures, swaps, and options. Anticipating that some positions would move in their favor and some would move against them, the firm relied on diversification across a large number of product and geographic markets. Long-term capital proved quite successful at this strategy, generating returns in excess of 40% in 1995 and 96, though somewhat less in 1997. Perhaps their success went to their heads. Long-term capital took on larger and larger positions. They also leveraged their investments at higher levels, returning capital to their investors, but not apparently reducing risks. We now also know that they took on significant positions in equity markets through both swap and options contracts. The reputations of the long-term capital partners as traders and economists and their initial success appear to have contributed to so many counterparties' willingness to deal with them. While hubris may have set them up for a fall, it was the extraordinary events of August in global markets that appear to have tripped them. On August 17th, the Russian government announced an effective devaluation of the ruble and declared a debt moratorium, shocking investor confidence all over the world. Over subsequent days and weeks, equity and debt markets the world over became increasingly volatile, with U.S. equity markets falling and the spreads between U.S. Treasury securities and higher-yielding debt instruments widening sharply. The correction of stock prices was not of exceptional size or concern, and indeed had been anticipated by a number of astute market observers. However, the abrupt and simultaneous widening of credit spreads globally for both corporate and emerging market sovereign debt was an extraordinary event beyond the expectations of investors and financial intermediaries. This unusual widening of credit spreads also caused significant losses at long-term capital. As markets around the world moved in the same direction at the same time, the diversification on which long-term had previously relied failed them utterly. Instead of offsetting positions, their losses were compounded. At the same time, the volatility in equity markets caused further losses. On September 2nd, the partners of long-term capital sent their investors a letter acknowledging 52% losses on the year through August 31st. That is, they had lost 52% of the capital they had at the beginning of the year, and that they were seeking an injection of capital to sustain the firm. The existence of this letter became widely known and reported within a few days. Because of this, during the first 2 weeks of September, concern about long-term capital was a widespread topic of conversation in financial markets. It is a traditional and essential role for the President and senior officers of the New York Fed to be talking to and receiving calls from market participants regarding significant developments and potential dislocations. In fact, the partners at long-term capital called me early in September to notify me of their difficulties and their discussion with investment houses about plans to raise new capital. By Friday, September 18th, with the efforts to raise new capital still unsuccessful, and with an increasing number of people now aware of long-term's plight because of the efforts to bring in new investors, events seemed to come to a head. With market conditions particularly unsettled that day, I made a series of calls to senior Wall Street officials to discuss overall market conditions. Now, let me take a moment to put those calls in context. One important objective of the Federal Reserve is to assure financial stability. Particularly in times of stress, it is essential that the Federal Reserve continue to take the pulse of the market. One way to do that is through candid and open communication with key market participants. Everyone I spoke to that day volunteered concern about the serious effect the deteriorating situation of long-term could have on world markets. Also on the 18th, one of the firms that had been working with long-term to raise new capital asked the long-term capital partners if the firm could share the information it had with us. The partners at long-term capital responded that they would prefer to present the information themselves and called me to arrange such a presentation. After conferring with Chairman Greenspan and Secretary of the Treasury Rubin, we agreed that a visit to Long-Term Capital's offices was needed. A team from the New York Fed, led by Peter Fisher, the head of our markets group, and joined by Treasury Assistant Secretary Gary Gensler, met with the Long-Term Capital partners at their offices on Sunday, the 20th of September. During this meeting, we learned the broad outlines of Long-Term Capital's major positions in credit and equity markets, the difficulties they were having in trying to reduce these positions in thin market conditions, their deteriorating funding positions, and an estimate of their largest counterparty exposures. The team also came to understand the impact which Long-Term Capital's positions were already having on markets around the world, and that the size of these positions was in fact much greater than market participants imagined. Now, Mr. Chairman, I would like now to turn to my second point and focus explicitly on the question of our judgment that the abrupt and disorderly closeout of Long-Term Capital's positions would pose unacceptable risks to the American economy. There are several ways that the problems of Long-Term Capital could have been transmitted to cause more widespread financial troubles. Had Long-Term Capital been suddenly put into default, its counterparties would have immediately closed out their positions. If counterparties would have been able to close out their positions at existing market prices, losses, if any, would have been minimal. However, if many firms had rushed to close out hundreds of billions of dollars in transactions simultaneously, they would have been unable to liquidate collateral or establish offsetting positions at previously existing prices. Markets would have moved sharply and losses would have been exaggerated. Several billions of dollars of losses might have been experienced by some of Long-Term Capital's more than 75 counterparties. Now, these direct effects on Long-Term Capital's counterparties were not our principal concern. While those losses would have been considerable and would certainly have adversely affected the firms experiencing them, this was not in itself a sufficient reason for us to have become involved. Two factors influenced our involvement. First, in the rush of Long-Term Capital's counterparties to close out their positions, other market participants, investors who had no dealings with Long-Term Capital, would have been affected as well. Second, as losses spread to other market participants and Long-Term Capital's counterparties, this would lead to tremendous uncertainty about how far prices would move. Under these circumstances, there was a likelihood that a number of credit and interest rate markets would experience extreme price moves and probably cease to function for a period of 1 or more days and maybe longer. This would have caused a vicious cycle, a loss of investor confidence leading to a rush out of private credits, leading to a further widening of credit spreads, leading to further liquidation of positions, and so on. Most importantly, this would have led to further increases in the cost of capital to American businesses and to American households. Let me be clear. Had we not just experienced in August precisely this type of shock to our credit markets, had we not just seen a sudden worldwide straining of investor confidence, had there not already been underway a flight of capital away from private credit and into Treasury securities, were much of the world not experiencing financial strain, then our judgments about the risks to the American economy of an abrupt and disorderly closeout of Long-Term Capital may well have been different. But in the circumstances that did in fact exist, it was our judgment, eventually my judgment, that the American people whom we are pledged to serve could have been seriously hurt if credit dried up in a general effort by banks and other intermediaries to avoid greater risk. In light of these risks, the responsible public policy objective was to get together those with a direct financial interest in an orderly rescue of Long-Term Capital, to discuss its problems openly and objectively, to provide a sounding board for solutions, and, if necessary, a calming influence. In my view, we achieved that objective. Now, what did the New York Fed do? Because events were moving swiftly, and with my approval and support, my colleague, Mr. Fisher, invited representatives of the three firms which we felt had the greatest knowledge of the situation at Long-Term Capital and a strong interest in seeking a solution to an early morning meeting on September 22nd. The three firms were Goldman Sachs, Merrill Lynch, and J.P. Morgan. Continuing discussions which commenced the day before Mr. Fisher explained our interest in being aware of developments and in reducing the risk of an abrupt and chaotic closeout of long-term capital. The firms present stated that they were not aware of any other initiative then being actively pursued to resolve long-term capital problems. They voiced their own concerns about the risks to the market of a closeout scenario. They discussed various approaches to stabilizing long-term capital, including the concept of a collective industry or a consortium approach. However, they all agreed that work on a collective option should not preclude parallel efforts by anyone. Indeed, that if any firm or group of firms wish to step forward and take long-term capital itself or long-term capital's positions onto their balance sheet, that would be the most desirable outcome. In the absence of any other solution, the firms dispatched 2 working groups to long-term capital's offices in Connecticut to consider the feasibility of lifting the fixed income and the equity positions out of long-term capital. A 3rd working group met at one of the firm's offices downtown in New York to develop the idea of a consortium approach. By mutual agreement, another firm, UBS, a Swiss bank, was added to this core group, making it 4, and to each of the 3 working groups. No one from the New York Fed participated in any of the working groups. At no point in this early morning meeting, nor at any stage last week, was there discussion of the use of public monies, Federal Reserve or otherwise. No Federal Reserve or government guarantees, actual or implied, were offered, discussed, or solicited. Later that Tuesday afternoon, we participated in a conference call to review the progress of the working groups. 2 of the working groups concluded that a lifting of the fixed income and equity positions was just not feasible. The 3rd group developed a consortium approach, which was deemed feasible. Everyone agreed that the consortium approach should be last ditch and that parallel solutions should still be encouraged. The 4 firms met at the Federal Reserve at 7 p.m. The draft term sheet was reviewed, which provided detail with respect to the consortium approach. The terms and conditions were debated, altered in some places, and ultimately refined so that the 4 firms could present it to a wider group. Although Federal Reserve officials were present at this meeting, we did not participate in the discussion about terms and conditions. At about 8:30 p.m., a meeting of a wider group involving 13 firms began, and meanwhile, some representatives of the 4 group called long-term capital to discuss the terms and conditions of the consortium approach. Federal Reserve officials did not participate in any conversations with long-term capital regarding the terms and conditions. In the meeting with the wider group, Peter Fisher explained the importance of avoiding a disorderly closeout of long-term capital's position. He also underscored the desirability of parallel efforts to resolve the problem. It was agreed that the group would reconvene at 10 a.m. the following morning. It was clear to everyone that time was of the essence. I had to give a long scheduled speech in London that Tuesday and returned late that evening, arriving in New York about midnight. During the early morning hours, I called various foreign central bank officials to inform them of the situation. At about 9:30 in the morning on Wednesday, my colleagues and I met with the core group to review the status of the situation. A few minutes before the start of the scheduled 10 a.m. meeting, one of the core group firms told me that an investor group would make an offer to acquire the long-term portfolio. I called one of the representatives of the investor group to confirm this development. The offer was subsequently conveyed to long-term capital by that investor group, and a response was requested by 12:30 p.m. After a brief consultation with the core group, I decided that the effort to proceed with the consortium approach needed to be suspended for a short time until this alternative offer could be considered. As noted earlier, the consortium approach was seen as a last resort. Consequently, the meeting about the consortium approach was adjourned at about 10:50 Wednesday morning to reconvene at 1 in the afternoon. At 12:30 p.m., I learned that the alternative offer had not been accepted and would not be extended. Shortly after 1 p.m., the meeting about the consortium approach resumed. This was now the only solution being pursued. During the next 5 hours, the private sector participants discussed every aspect of the terms and conditions. At the end of the discussion, 14 banks and securities firms agreed to participate in the recapitalization, with 3 firms contributing smaller amounts than the other 11, 2 firms represented at the meeting decided not to participate. I want to emphasize a few points. First, this was a private sector solution to a private sector problem, involving an investment of new equity by long-term capital's creditors and counterparties. Second, although some have characterized this as a bailout, control of the long-term portfolio passed to this 14-firm creditor group, and the original equity holders have taken a severe hit. Finally, no Federal Reserve official pressured anyone, and no promises were made. Not one penny of public money was spent or committed. It is far too early, Mr. Chairman, to state categorically the lessons to be learned from long-term capital. What I can say is that we are focused on 3 specific issues, all relating to leverage and how we are able to observe it through the eyes of our bank examiners. Let me emphasize yet again that the Federal Reserve has no regulatory authority over hedge funds and therefore no regulatory authority over long-term capital. The first issue relates to credit analysis. Our supervisory guidance generally, and with respect to hedge funds specifically, stresses the importance of knowing the borrower and the business purpose of the borrower's transactions. In 1994, the Federal Reserve issued a supervisory letter emphasizing the importance of financial analysis of counterparties, including hedge funds, which can quickly adjust their risk profile. There is a question whether adequate credit analysis was performed by creditors of long-term capital, and that needs to be examined carefully during the next few weeks. If credit analysis was deficient, we need to learn how and why before we can make pronouncements that will avoid repetition of our long-term capital experience. The second issue relates to derivatives activities and a concept called future potential exposure, which is a measure of the likely price movements based on recent years' experience. With respect to derivatives, the current market value is captured by financial statements prepared in accordance with generally accepted accounting principles, but not the potential future exposure. To fully understand the degree and effect of leverage in long-term capital's derivatives-related strategies, it would have been necessary to measure the potential future exposure in a rigorous and conservative manner. Whether sufficient information was made available to long-term capital's counterparties, including its banks, and adequately analyzed by those counterparties also needs to be studied. A third question concerns stress testing in the credit analysis of hedge funds and the structuring of margin agreements. Stress testing simulates the effects on a portfolio if many asset relationships simultaneously move adversely far beyond historical observation. And we recognize that stress testing is a developing discipline, but it is clear that adequate testing was not done with respect to the financial conditions that precipitated long-term capital's problems. In a recent supervisory letter on credit underwriting generally, we emphasized the importance of stress testing. Effective risk management in a financial institution requires not only modeling, but models that can test the full range of financial transactions across all kinds of adverse market developments. Whether such models existed, and if so, whether they were effective, are issues that we need to address. In the aftermath of long-term capital, we need to pursue these leverage-related issues and others in conjunction with our colleagues at the Federal Financial Institutions Examinations Council, the Fed, the FDIC, and the Office of the Comptroller of the Currency. The insights that we gain should be of value to bank supervisors and for the study of the long-term capital matter that is to be done by the President's Working Group on Financial Markets announced by Secretary Rubin last Friday. Mr. Chairman, I thank you for the opportunity to appear before you this morning.
Thank you, Mr. McDonough. Chairman Greenspan.
Thank you very much, Mr. Chairman, members of the committee. I, too, want to thank you for the opportunity to report on the Federal Reserve's role in facilitating the private sector refinancing of the large hedge fund long-term capital management. In my remarks this morning, I will attempt to put into some perspective the events of the past few weeks and discuss some questions of importance to public policy matters that they raise. The Federal Reserve Bank of New York's efforts were designed solely to enhance the probability of an orderly private sector adjustment, not to dictate the path that adjustment would take. As President McDonough just related, no Federal Reserve funds were put at risk, no promises were made by the Federal Reserve, and no individual firms were pressured to participate. Officials at the Federal Reserve Bank of New York facilitated discussions in which the private parties arrived at an agreement that both served their mutual self-interest and avoided possible serious market dislocations. Financial market participants were already unsettled by the recent global events. Had the failure of LTCM triggered the seizing up of markets, substantial damage could have been inflicted on many market participants, including some not directly involved with the firm, and could have potentially impaired the economies of many nations, including our own. With credit spreads already elevated and the market prices of risky assets under considerable downward pressure, Federal Reserve officials moved more quickly to provide their good offices to help resolve the affairs of LTCM than would have been the case in more normal times. In effect, the threshold of action was lowered by the knowledge that markets had recently become fragile. Moreover, our sense was that the consequence of a fire sale triggered by cross-default clauses should LTCM fail on some of its obligations risked a severe drying up of market liquidity. The plight of LTCM might scarcely have caused a ripple in financial markets or among financial regulators 18 months ago, but in current circumstances, it was judged to warrant attention. What is remarkable is not this episode, but the relative absence of such examples over the past 5 years. Dynamic markets periodically engender large defaults. In our dynamic market economy, investors and traders at times make misjudgments. When market prices and interest rates adjust promptly to evidence of such mistakes, their consequences are generally felt mostly by the perpetuators and thus rarely accumulate to pose significant problems for the financial system as a whole. By such winnowing of inefficiencies, productivity is enhanced and standards of living expand over time. Financial markets operate efficiently only when participants can commit to transactions with reasonable confidence that the risk of non-payment can be rationally judged and compensated for. Effective and seasoned markets pass this test almost all the time. On rare occasions, they do not. Fear, whether irrational or otherwise, grips participants and they unthinkingly disengage from risky assets in favor of those providing safety and liquidity. The subtle distinctions that investors make, so critical to the effective operation of financial markets, are abandoned. Assets, good and bad, are dumped indiscriminately in circumstances of high uncertainty and fear that are not conducive to planning and investment. Such circumstances, were they generalized and persistent, would be wholly inconsistent with the functioning of sophisticated economies supported by long-term capital investment. Quickly unwinding a complicated portfolio that contains exposure to all manner of risks, such as that of LTCM, in such market conditions amounts to conducting a fire sale. The prices received in a time of stress do not reflect longer-run potential, adding to the losses incurred. Of course, a fire sale that transfers wealth from one set of sophisticated market players to another without any impact on the financial system overall should not be a concern for the central bank. Moreover, creditors should reasonably be expected to put some weight on the possibility of a large market swing when making their risk investments and assessments. Indeed, when we examine banks, we expect them to have systems in place that take account of outsized market moves. However, a fire sale may be sufficiently intense and widespread that it seriously distorts markets and elevates uncertainty enough to impair the overall functioning of the economy. Sophisticated economic systems cannot thrive in such an atmosphere. The scale and scope of LTCM's operations, which encompassed many markets, maturities, and currencies, and often relied on instruments that were thinly traded and at prices that were not continuously quoted, made it exceptionally difficult to predict the broader ramifications of attempting to close out its positions precipitously. That its mistakes should be unwound and losses incurred was never open to question. How they should be unwound and when those losses incurred so as to foster the continued smooth operation of financial markets was much more difficult to assess. The price gyrations that would have evolved from a fire sale would have reflected fear-driven judgments that could only impair effective market functioning and generate losses for innocent bystanders. While the principle that fire sales undermine the effective functioning of markets may be clear, deciding when a potential market disruption rises to a level of seriousness warranting central bank involvement is amongst the most difficult judgments that ever confronts a central banker. In situations like this, there is no reason for central bank involvement unless there is a substantial probability that a fire sale would result in severe, widespread, and prolonged disruptions to financial market activity. It was the judgment of the officials at the Federal Reserve Bank of New York who were monitoring the situation on an ongoing basis that the act of unwinding LTCM's portfolio in a forced liquidation would not only have a significant distorting impact on market prices, but also in the process could produce large losses or worse for a number of creditors and counterparties and for other market participants who were not directly involved with LTCM. In that environment, it was the Federal Reserve Bank's judgment that it was to the advantage of all parties, including the creditors and other market participants, to engender, if at all possible, an orderly resolution rather than let the firm go into disorderly fire sale liquidation following a set of cascading cross defaults. Their agreement was not a government bailout in that Federal Reserve funds were neither provided nor even ever suggested. Agreements were not forced upon unwilling market participants. Creditors and counterparties calculated that LTCM and accordingly their claims would be worth more over time if the liquidation of LTCM's portfolio was orderly as opposed to being subject to a fire sale. And with markets currently volatile and investors skittish, putting a special premium on the timely resolution of LTCM's problems seemed entirely appropriate as a matter of public policy. Of course, any time that there is a public involvement that softens the blow of private sector losses, even as obliquely as in this episode, the issue of moral hazard appropriately arises. Any action by the government that prevents some of the negative consequences to the private sector of the mistakes it makes raises the threshold of risks market participants will presumably subsequently choose to take. Over time, economic efficiency will be impaired as some uneconomic investments are undertaken under the implicit assumption that possible losses may be borne by the government. But is much moral hazard created by aborting fire sales? To be sure, investors wiped out in a fire sale will clearly be less risk-prone than if their mistakes were more orderly unwound. But is the broader market well served if the resulting fear and other irrational judgments govern the degree of risk participants are subsequently willing to incur? Risk-taking is a necessary condition for wealth creation. The optimum degree of risk aversion should be governed by rational judgments about the marketplace, not the fear flowing from fire sales. the Federal Reserve provided its good offices to LTCM's creditors not to protect LTCM investors, creditors, or managers from loss, but to avoid the distortions to market processes caused by a fire sale liquidation and the consequent spreading of those distortions through contagion. To be sure, this may well work to reduce the ultimate losses to the original owners of LTCM, but that was a byproduct, perhaps unfortunate, of the process. Without doubt, extensive study will be required to put the events of the past few weeks into proper perspective. As a member of the President's Working Group on Financial Markets, I support Secretary Rubin's call for a special study on the public policy implications of hedge funds. While the affairs of LTCM are by no means settled, I would like to pose some tentative questions that may have to be addressed. First, how much dependence should be placed on financial modeling, which for all its sophistication can get too far ahead of human judgment? This decade is strewn with examples of bright people who thought they had built a better mousetrap that could consistently extract an abnormal rate of return from financial markets. Some succeeded for a time, but while there may occasionally be misconfigurations among market prices that allow abnormal returns, they do not persist. Second, what steps could counterparties have taken to ensure that they had properly estimated their exposure, particularly in markets that are volatile? To an important degree, the creditors of LTCM were induced to infuse capital into the firm because they failed to stress test their counterparty exposures adequately and therefore underestimated the size of the uncollateralized exposure that they could face in volatile and illiquid markets. In part, this also reflected an underappreciation of the volume and nature of the risks LTCM had undertaken and its relative size in the overall market. By failing to make those determinations, its fellow market participants failed to put an adequate brake on LTCM's use of leverage. Third, in this regard, what lessons are there for bank regulators? Domestic commercial bank exposure to LTCM included both direct lending and acting as counterparties to the firm in derivatives contracts. A preliminary review of bank dealings with LTCM suggests that the banks have collateral adequate to cover most of their current mark-to-market exposures with LTCM. The unexpected surge in risk aversion and the dramatic opening up of interest rate spreads in August obviously caught LTCM wrong-footed. Counterparties, including banks, continued to collect collateral for marks to market. What they were not collateralized against was the losses that might have occurred when prices moved even further and market liquidity dried up in a fire sale. Supervisors of banks and securities firms must assess whether current procedures regarding stress testing and counterparty assessment could have been improved to enable counterparties to take steps to insulate themselves better from LTCM's debacle. Fourth, does the fact that investors have lost most of their capital and creditors may take some losses on their exposures to LTCM call for direct regulation of hedge funds? It is questionable whether hedge funds can be effectively directly regulated in the United States alone. While their financial clout may be large, hedge funds' physical presence is small. Given the amazing communications capabilities available virtually around the globe, trades can be initiated from almost any location. Indeed, most hedge funds are only a short step from cyberspace. Any direct U.S. regulations restricting their flexibility will doubtless induce the more aggressive funds to emigrate from under our jurisdiction. The best we can do, in my judgment, is what we do today. Regulate them indirectly through the regulation of the sources of their funds. We are thus able to monitor far better hedge funds' activity, especially as they influence U.S. financial markets. If the funds move abroad, our oversight will diminish. In the first line of risk defense, if I may put it that way, are hedge funds, lenders, and counterparties. Commercial and investment banks especially have the analytical skills to judge the degree of risk to which the funds are exposed. Their self-interest has, with few exceptions, but including the one we are discussing today, controlled the risk posed by hedge funds. Banking supervisors are the second line of risk defense in their examination of lending procedures for safety and soundness. We neither try nor should we endeavor to micromanage bank lending activity. We have nonetheless built up significant capabilities in evaluating the complex lending practices in OTC derivatives markets and hedge funds. If somehow hedge funds were barred worldwide, the American financial system would lose the benefits conveyed by their efforts, including arbitraging price differentials away. The resulting loss in efficiency and contribution to the financial value added and the nation's standard of living would be a high price to pay, in my mind, too high a price. Fifth, how much weight should concerns about moral hazard be given when designing mechanisms for governmental regulation of markets? By way of example, we should note that were banks required by the market or their regulator to hold 40% capital against assets as they did after the Civil War, there would, of course, be far less moral hazard and far fewer instances of fire sale market disruptions. At the same time, far fewer banks would be profitable, the degree of financial intermediation less, capital would be more costly, and the level of output and standards of living decidedly lower. Our current economy, with its wide financial safety net, fiat money, and highly leveraged financial institutions, has been a conscious choice of the American people since the 1930s. We do not have the choice of accepting the benefits of the current system without accepting its costs. For so long as there have been financial markets, participants have had on occasion to weigh the costs and especially the externalities associated with fire sale liquidations of troubled entities against short-term assistance to tide the firms over for a time. It was such a balancing of near-term costs and longer-term benefits that presumably led J.P. Morgan the Elder to convene the leading bankers of his age, both commercial and investment, in his library in 1907 to address the severe panic of that year. Such episodes were recognized as among those rare occasions when otherwise highly effective markets seize up and temporary ad hoc responses were required. The convening of LTCM investors and lenders last week at the Federal Reserve Bank of New York could be viewed in that long tradition. It should similarly be viewed as a rare occasion, warranted because of the potential for serious disruptions to markets. We must also remain mindful where to draw the line at which public sector involvement ends. The efforts last week were limited to facilitating a private sector agreement and had no implications for Federal Reserve resources or policies. Mr. Chairman, I've excerpted from my prepared remarks and request that they be included for the record.
Without objection, so ordered. Let me just begin by saying that the position of the Fed, in one sense, I think, has been overstated. That as you posit the issue of orderly resolution versus a fire sale, you have some rationalization for ACT. But it would appear that there was another offer on the table, and that perhaps the only smart deal of the month that long-term managements did was they played the Fed off against another party. And the other party offered half as much cash and probably provided a much less attractive deal for management in terms of their positions at the fund. And so it strikes me that that's a dilemma that the Fed has to understand and has to deal with. The second dilemma that I think is extraordinary is that it might be argued that the current situation and the future situation for long-term capital is going to be a greater problem than the problem that existed last week. That is, last week, all you had to deal with was management of a potential bankruptcy. Today and henceforth, you are dealing with a quasi-cartel circumstance, a fund with its new partners that in concert represent extraordinarily greater firepower than the central banks of all the countries in the world in terms of affecting issues like currency valuations. And so what you've done is establish, with the sanction of the Federal Reserve Board of the United States, a cartel. And I would argue that if this group of 14 institutions, or principal ones, came to you and said, we would like to combine a traditional banking function, let's say a trust department, the regulators would instantaneously deny such an application because of its obvious monopolistic implications. Now you've allowed this in this circumstance, and you've allowed the fund not only to continue, but to potentially grow substantially, which makes me think that the only rationalization for the Federal Reserve intervention in the manner it did that holds weight for the future would be if the exclusive intent was to unwind the fund. And so the principal question I have to you is it your intent to allow these institutions to work in concert to manage a fund as it currently operates and potentially grow, or is it your intent that this fund should unwind?
Let me answer that, and then Bill McDonough could follow up. Well, first of all, Mr. Chairman, had we never been involved in the slightest, and in fact had not known anything about it, for example, it was still conceivable that this grouping, the same grouping, would have come together in their mutual self-interest to endeavor to facilitate an orderly resolution of a particular financial institution in which they were all involved. That's a practice which goes on fairly considerably, and I think appropriately so.
If I could interrupt briefly, part of the group did come together to attempt exactly that, involving other parties, and the Fed ended up putting together a group that competed with the other group, which is an extraordinary dimension to this whole discussion.
Well, let me just complete my remarks, and then I'll turn it over to Bill. I think you're raising a number of issues which really relate to the question which are on the edge of antitrust actions, and I think that those questions would emerge whether or not we were involved, and I think that they have to be dealt with in a separate context. I myself am far less concerned than you are with respect to the potentials that might arise from that, but it's a separable issue and really, in one sense, quite unrelated to the issue of the particular elements that we are involved in discussing today, but clearly surface largely because of the nature of the actions that have been taken. Bill?
Mr. Chairman, let me comment further on how the fund would operate now. The antitrust laws, and I believe other laws involving fiduciary responsibility, will make it very clear that the people in the oversight committee who are in there instructing the old managers of how to manage the fund have to have an absolute Chinese wall infinitely high between them and their parent firms, because if they don't, it would seem to me as a non-lawyer they would be clearly in violation of the antitrust laws, and the concern that you have of this amassing of power would be completely clearly correct. I think the laws that already exist provide insurance against that. Secondly, the investors, the new investors, you will note, are in there for 3 years. The reason they say they're in there for 3 years, even though they would love to be out long before 3 years, is that because the positions are so large, if you go back to the chairman's fire sale analogy, if they say we're going to be in business for a month or 2 months or 3 months, you still have a fire sale, you just have a fire sale on the installment plan. And all of the concern about the spreads moving out and so on would happen anyway. So they have to show that they have the ability and the staying power to unwind the positions in an orderly manner, which is in fact what they have in mind. As regards your earlier concern about did we, by getting the group together that eventually formed the consortium, make it less likely that another deal, which has now been rather thoroughly discussed in the media, did it make it less likely that that deal would prosper? Well, first of all, as I suggested in my prepared testimony, all through the period of talking with the group, the core group, and eventually the consortium group, everybody was in agreement that that really was not a particularly desirable thing and that it was a last ditch. It was better than allowing the firm to collapse, but it was not something that people were very enthusiastic about. Now, just to go back to why we were involved at all, I mentioned that I thought that the American people would be adversely affected by a collapse of long-term capital. Now, how? We have a situation in which Treasury securities, the 30-year bond, is now below 5%. And although the bond rate, the interest rate on bonds of the highest quality credits in our country have also come down a little bit, the spread between them and Treasuries, the interest rate differential, is phenomenally high. And one of the reasons that the rates have come down at all, even though the difference is very large, is because there's a general view that no chief financial officer in his right mind would be issuing credit in these very chaotic markets. So there's a view that the supply of that paper will be decreasing, or at least held constant. What I think we need to really look at is what is happening to the interest rates on lower quality credits, BAA, BBB. These are the lower end of the larger firms, but it's especially the medium-sized and smaller firms that, as you're well aware, are the whole source of job creation in our country. And if we had, the fear that we had was that given this really chaotic market background, that if LTCM had collapsed, that it would get that much worse and we'd have a credit crunch. And can I assure you that would have happened? Of course not. But it was our collective judgment at the New York Fed that that would have been sufficiently likely that it should have avoided. Now let me get to the alternative deal. On the Wednesday morning, as I mentioned, at approximately 10 o'clock, one of the people in the core group said to me, I would like to have a private conversation with you. He and I went into my office and he said, there is an alternative offer that is able to be made. And in order to have you convinced that it's real, would you call a rather prominent individual and talk to him to make sure that you really believe it's there? I did that. That's why we decided to adjourn the consortium group meeting. So we had some of the great names on Wall Street sitting in the boardroom of the New York Fed, I walk in at 10:45 and say, ladies and gentlemen, there is a possibility of another offer that will make this consortium deal unnecessary, which all of you don't like anyway, and therefore we will adjourn the meeting till 1 o'clock. So we left the whole terrain available for the alternative deal for as long a period as the alternative deal was available. So if we did anything, tell you the truth, as I try to do always, we actually favored the alternative deal. And I had, in fact, I received a phone call from the two Mr. Merriweather and another colleague of his at Long-Term Capital. They said, do you know that there is an offer? I said, yes, I do. They said, do you know the terms of the offer? I said, yes, I do. And they said, well, we are examining the offer, and we are seeing, among other things, whether we have the legal authority under our partnership agreements and under our agreements with our investors to accept the offer, and we don't know the answer to that yet. That's a legal question. I said to them, gentlemen, you should be very well aware that that's the only offer available to you. There is no guarantee whatsoever that this consortium approach is ever going to come together. I don't know whether it will come together. There are lots of people with different interests who have to come together and think they have a common interest for that to appear. And then I remind them of the adage that we all learned as kids, a bird in the hand is worth two in the bush. That's the advice I gave them, and then we ended the conversation. Several hours later, I was informed by this top officer of the firm that would have been one of the participants in that deal that didn't work, that the deal had not been realized, that the offer was off the table, and therefore the only game in town, other than a collapse of long-term capital, was what we now call the consortium deal. So to conclude, Mr. Chairman, if anything, we made it more likely than not that the alternative offer would have been accepted.
Well, I appreciate that. I'm not necessarily overwhelmingly convinced. It looks to me as if the offer was turned down by the officers of the potentially bankrupt institution, and that you were held hostage to their judgment. And that is not a strong position to be in.
May I comment?
Yes?
I think we had a discussion going on between long-term capital and a group of 3 investors. For us, the involvement I described of the bird in the hand worth two in the bush is, I think, as close to the edge as any senior central banker should ever go, and maybe right at the edge of getting involved in a situation and encouraging an outcome. I can't imagine that anything that the long-term capital people would have heard would have encouraged them to believe that I was somehow saying in any way, why don't you bet on the alternative? The alternative available to them at that time was either they accepted the offer that eventually did not fly. I believe that their reason is that they didn't have the legal power to do it. I don't know if that's the fact or not. But it was a discussion between 2 private parties. We can't get involved and say this has to be the outcome.
Well, the only thing that should be stressed is that there was not this chasm that has been described in both of your testimonies of disorderliness. Long-term capital management clearly understood that there's a possibility of another offer in the making, and they in effect played a bit of a game and appear to have won that game. Mr. LaFosse.
Yes. Mr. Chairman, I request that the committee make an official request to the chairman of the Financial Accounting Standards Board for his opinion on this issue and the appropriate type of accounting standards that may be necessary in light of it. And if necessary, if the Federal Reserve would then like to comment on his response at that time, I think that might be helpful to the committee.
It's very reasonable without objection.
Secondly, I ask that we insert in the record copy of Mr. Roger Altman's article in this morning's Washington Post, former Deputy Secretary of the Treasury, entitled Dangerous Bailout.
Without objection.
Third, Mr. Altman makes reference to the fact that Prime Minister Blair this week called for a global conference on the need for a new architecture for financial regulation and supervision. What is the current mechanism for that, Chairman Greenspan, that is for achieving much greater global regulation and supervision that is adequate to the task? It seems to me that within the next year, this is something that Chairman Leach and I and you and others, the administration, must be working on aggressively, more so in the future than we have in the past.
Mr. LaFalce, let's not presume that the ideal outcome is more regulation. I think the ideal outcome is a regulatory structure which addresses the changes in the international financial system in a manner which will enhance its stability and lower the probabilities of difficulties. We've been discussing this issue before this committee when we've been involved with the questions of the nature of the crises which have arisen since the problems in Thailand arose and the extraordinary contagion went around the world. In my judgment, I think we probably are we're beginning to increasingly understand the
question, Chairman Greenspan. I'm not so much interested in the answer right now as I am the mechanism.
Okay. As you're probably aware, there's a meeting of the G7 finance ministers and central bank governors on Saturday. There is a meeting of the G10 finance ministers and central bankers on Sunday. There is a meeting of the so-called G22, which is the particular vehicle which is going to address in some detail many of the alternate issues that have come forth with respect to examining the issues that have come forth which are alternate structures for what is now being termed the new international financial architecture. I don't want to discuss in advance what I think will come out of that meeting, but I do know
central bankers and mechanisms they have for participation in the discussions about new global financial architecture. And I distinguish between two different architectures, one for the IMF and its role, and the others for the regulation and supervision and the laws that need to be in place, whether bankruptcy laws, transparency laws, etc.
Well, we are doing, these central bankers have a fairly advanced set of procedures, and indeed, wearing another hat, Bill McDonough is chairman of the Basel Committee on Bank Supervision, which is the vehicle which is employed by the major central bankers around the world for coordinating bank regulation. And that's an ongoing process. And
I wasn't just thinking of bank, I was thinking of financial institutions.
Well, but the reason Mr. LaFalce, the reason I started with the question of the nature of the international financial structure is that I've always argued in architectural terms that you want form to follow function. In other words, you really want to understand what type of vehicle we're dealing with. As I've mentioned many times before this committee, I believe that the extraordinary changes in technology which have come upon us in the last decade or so have created sets of instruments and structures in the international financial community that are different from what has existed previously, and that the supervisory regulatory approach which should be applied to this new vehicle in turn also must be different from the structure that we have had in the past. I think we're gradually moving in that direction, and we're moving on two parallel tracks. One is a far better understanding of what this new international structure, financial system is all about, and two, what are the types of supervisory and regulatory structures which we can impose, which will effectively interact with that.
All right, let me try to get in at least another question, and that is, what legal authority exists right now on the part of any regulator to impose margin requirements? And if there's if there is legal authority, you know, who has it, who exercised it? If there isn't legal authority, ought it to exist, and who should have it? And that's one question. My second question has to go to the question of the role of insurance companies. I assume each of these partners, for example, had some type of insurance coverage for mismanagement, etc. Did we consider having the insurance companies play a role in the private sector supervision of a fund that they are basically insuring against mismanagement, or B, involving them in the bailout as opposed to the firms that had simply made loans? So those two questions.
First, let me say, as far as legal authorities on margin, obviously we do have legal authority to impose margins on stock trades, which we have not employed for many years